Hey everyone, and welcome to The Explainer. So, I want you to imagine a scenario for a second. Think about your parents, or maybe a retired couple you know, right? Back in the day, they likely bought their very first home in their late 20s. They just worked a regular job, socked away a little bit of savings each month, and honestly, pretty easily secured a place to raise a family. But today? Man, today is a whole different story. Even if you're pulling in a fantastic salary, you might be totally struggling just to buy a tiny bare bones apartment. House prices are literally shattering records, rent is skyrocketing, and yet, our salaries? They're barely budging. So, what exactly changed? Well, today we are going to decode this modern housing crisis and figure out exactly why the dream of owning a home feels like it's just slipping away for an entire generation. Okay, let's dive into this. It's totally natural to wonder, right? Like, did the actual physical bricks, the wood, the cement, did all that suddenly become astronomically more expensive to put together? Are we just earning less than people used to? Or, and this is what a lot of really frustrated first-time buyers suspect, is there some massive rigged system working behind the scenes? Well, to figure that out, we've got to look at the raw data and unpack the actual mechanics of the housing market. Let's start with the math, because this absolutely validates the frustration so many of us are feeling right now. Think back to the year 2000. Back then, if the average salary was $40,000, an average home cost about $180,000. If you crunch the numbers, that means a house cost roughly 4.5 years of your income. Not too bad, right? Well, fast forward to today. Sure, the average salary has bumped up to around $60,000, but that exact same average home, it has completely skyrocketed to $500,000, or honestly even more. To put that into perspective, you now need over 8 years of income to buy that exact same house. So yeah, salaries did increase, but home prices, they grew exponentially faster.
Section 1. The dying housing dream. When houses stopped being homes.
You know, a long time ago, buying a house was simply about securing a stable place to live. It wasn't some grand financial scheme. Back in the 1960s, a house basically cost just 2 to 3 times the median person's yearly salary. And with programs like the GI Bill in the US, veterans could easily afford homes on just a single income. It really wasn't about getting rich. But contrast that with the global reality we are seeing today. Across the US, Canada, the UK, Australia, and Germany, homes in major cities now cost a staggering 8 to 15 times the average annual salary. Literally, even if you saved every single penny you earned, it would take years just to afford the most modest property out there.
Section 2. From shelter to investment. The asset transformation.
And this brilliantly illustrates what experts call the financialization of shelter. Now, what does that actually mean? Well, instead of a house just being a place to live, wealthy individuals and massive corporate funds started looking at homes simply as a way to make money. They're buying up multiple properties not because they actually need a roof over their heads, but purely because they expect the prices to keep rising. This creates this massive artificial demand. When housing transforms from basic shelter into a speculative asset and everyone suddenly wants a piece of that asset, it just becomes incredibly expensive.
But you might be wondering, how did everyone suddenly get the money to bid up these prices in the first place? Well, after the 2008 financial crisis, and then again during COVID-19, central banks lowered interest rates to near zero. They did this to stimulate the economy, but this cheap money totally changed the game. Suddenly, a buyer who previously only qualified for a $150,000 loan could borrow $400,000. But here's the catch. The house itself didn't get any better. It's the exact same house. The loan just got bigger, which meant buyers simply used all that extra debt to bid up the prices of the exact same houses.
Now watch what happens when inflation flips the script. When central banks aggressively raised interest rates to fight inflation, everything completely changed. Just think about the math here. A $400,000 mortgage at a 3% interest rate costs you about $1,700 a month. But at a 7% rate, that exact same loan costs nearly $2,700 a month. That is almost $1,000 extra every single month for the exact same house. So today, buyers are totally trapped. They're getting hit with both historically high house prices and punishingly expensive loans at the exact same time. Section 3. The Great Supply Shortage, the Physical Bottlenecks. So we have a severe supply shortage globally, and honestly, several systemic culprits are to blame for this. First off, you've got strict zoning laws that often explicitly ban apartments or smaller units, which pretty much ensures only a few larger homes can ever be built. Second, some developers engage in land hoarding. They'll literally just sit on empty plots of land waiting for property values to rise before they even start building. Third, the raw materials, things like steel and cement, plus major labor shortages have made actual construction slower and way more expensive. And finally, investors sometimes buy homes and leave them totally empty. These zombie houses just sit there completely lifeless, waiting for the market to tick up. And because of all these massive hurdles and the crazy high costs of building, developers are forced to make a choice. Think about it. When they finally navigate all the permits and shell out for the expensive steel and labor, they naturally prioritize high-profit, large luxury homes. The profit margins are just way better for them. And as a result, the modest, affordable starter home, the very type of house a first-time buyer actually needs, has almost completely disappeared from new construction. Section 4. The Wall Street Takeover. The Corporate Competitors. So the crucial point is this truly staggering statistic. 25% of the market, literally 1 in 4 homes, is now bought by investors. Just imagine for a second that you've been saving up for years, you finally find the perfect modest home, and you are ready to buy. But suddenly, an investment firm swoops in, offers all cash, way above the asking price, and asks for 0 delays. Who do you think the seller is going to choose? It's a no-brainer for them. Regular families are just being routinely outbid. And we aren't just talking about mom-and-pop landlords anymore. We are looking at massive mega firms and Wall Street hedge funds like Blackstone and Invitation Homes. Some of these institutional investors own tens of thousands, sometimes even over 100,000 properties. They are literally buying up entire neighborhoods with the specific goal of just renting them right back to the public. By treating residential real estate like it's a stock portfolio, they are actively turning potential homeowners into lifelong renters, all to generate continuous profit for their shareholders. Oh, and it's not just long-term corporate landlords causing issues. Unregulated short-term rentals are seriously squeezing the market too. It's the Airbnb effect, where residential homes are essentially being run like unregulated hotels. And while that's great if you're a tourist, it completely chokes off the local housing supply. It's actually become so severe in tourist hotspots like Barcelona, Spain, that we are seeing massive local pushback and huge protests. Locals are quite literally being driven out of their own cities simply due to a lack of available, long-term housing. Section 5. High costs of building, the vicious cycle. Let's move to and see how this builds into a truly vicious cycle for everyday people. Step 1, you can't afford to buy a house. Step 2, because you can't buy, you're forced to stay in the rental market. Step 3, well, since millions of other people are also stuck renting, the demand for rentals skyrockets. Step 4, landlords see this and raise prices, and suddenly your rent is consuming 40% or even more of your total income. Which inevitably leads to step 5, because your rent is so painfully high, you have absolutely no money left over to save for a down payment. That old classic advice of, just rent while you save up. Yeah, it simply no longer works with this math. And hey, if you think you can just hold out and wait for developers to build more cheap housing to break this cycle, well, the recent data paints a very different and honestly rather grim picture of where the market is actually heading. We are currently looking at what experts call a total nationwide collapse in affordable new single-family homes. The numbers reveal a massive drop. Back in the US in 2020, about 40% of all new single-family homes sold for under $300,000. Fast forward just 4 short years to 2024, and that number has plummeted to somewhere between 16 and 23%, depending on where you look. This data brilliantly illustrates that affordable housing is just evaporating. Without major systemic changes, renting isn't just some temporary stepping stone anymore. It's at serious risk of becoming the permanent default for an entire generation. Section 6. Can we fix this? The new reality and potential fixes. So, how do we get out of this mess? Experts have actually proposed several systemic solutions. First up, implementing a land value tax. This would basically penalize developers who just hoard empty land. Second, enacting major zoning reforms to legally allow the building of a lot more multifamily apartments and smaller starter units. Third, legally banning these massive corporate firms from buying up single-family homes, which would finally give regular families a fighting chance. And finally, reducing the current tax benefits that actually reward investors for owning multiple homes, which would heavily disincentivize property hoarding. Now, you're probably asking, if the solutions are there, why aren't politicians rushing to pass these laws? Well, here is the impartial, incredibly tricky political contradiction right at the heart of the crisis. Roughly 65% of Americans already own homes. If the government suddenly floods the market with new supply and house prices actually drop to make them affordable for new buyers, all those current homeowners lose their property value. Furthermore, a sudden sharp drop in prices could have a 2008-style crash where people suddenly owe the bank way more than their house is even worth, leading to mass bankruptcies. Put simply, intentionally dropping house prices is just incredibly dangerous politically, so the gridlock just continues. Ultimately, the global housing crisis isn't just a matter of people not working hard enough or, buying too much avocado toast. It is a highly complex, rigged game fueled by critically low supply, the era of cheap money, and deep systemic shifts in how we actually view property. And it leaves us with a profound philosophical debate as we look to the future. So I want to leave you with this final provocative thought to chew on. Should housing, fundamentally, be treated as a lucrative financial investment for those with capital? Or must it be protected as a basic human need? Thank you so much for exploring this explainer with us, and always keep questioning the systems around you.